Welcome to SB Talks. Today is Monday, May 19th, and I am joined as ever by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, this week, Nick and I will be discussing the Reserve Bank of Australia's meeting to make the latest decision on rates. We'll talk the latest on tariffs and the taco trade, as well as sharing our take on the strong equity market recovery over the past 5 weeks. Welcome to all our listeners. Let's start closer to home this week. We have an RBA meeting this week with a fairly consensus expectation of a cut. Perhaps you can talk us through some of the factors that will be weighing on the decision-making process for the Reserve Bank.
I think it comes down to a couple of things. Firstly, it's inflation. So the most recent inflation data showed that inflation back inside that 2 to 3% target range for the trim mean. And, you know, on a sort of a shorter term basis, definitely heading back towards the midpoint of the target range. So it gives the RBA more confidence that inflation is on track.
Moving in the right direction.
Yeah. I guess balancing against that is the strength of the labour market. So we had another strong employment report for the month of April, 89,000 jobs created, well above expectations. Unemployment rate steady at 4.1%, where it's been for about a year. So still, you know, quite low unemployment rate. Really no signs of slowing there. And we also
fairly robust economic position.
Yeah, and we also had the wages data for the first quarter that came in a little bit stronger than expected, 0.9% for the quarter, 3.4% for the year. So up a little bit. So I think it's that strength of the labour market versus weakness in retail spending. So we've seen retail spending being reasonably soft.
For some time now.
Yeah. And so I think in volume terms it was down or flat for the first quarter. So really no real growth in spending, you know, and this is when we have an expanding population, you know, so.
A continuation of the per capita recession thesis.
Yeah.
Now, obviously, as speculation is built towards this meeting, we've had the big overhang of rapidly shifting US trade policy, tariffs, all those factors, which no doubt we'll come and talk to as well. That's probably eased somewhat relative to, I guess, the fear level there, relative to a few weeks earlier. And that seems to have dialed back some of the, I guess, more extreme calls for or expectations of a 50 basis point cut.
Yeah, I think only NAB still has a 50 basis point cut, but even they've sort of been backing away from that. I think 100% of economists have 25 basis points, 100% have a rate cut this week, but most of those are for a quarter point cut.
And what are you seeing in terms of the outlook beyond the May meeting and later in the year?
Yeah, I think the RBA will probably be reluctant to give too much away when they do cut this week. So it'll be a bit similar to February where they cut but didn't really give too many clues as to what or when the next cut would be. So I think we'll probably see that again. They'll probably be fairly cautious. They'll talk about risks from the global trade uncertainty. They'll talk about the domestic economy being somewhat soft but still strong employment. So I think they'll hedge their bets a bit.
And of course, since the RBA's last meeting, we've had a fairly decisive result in the federal election here in Australia. So we don't have a hung parliament. We don't have sort of minority propped up government. In that regard, there's probably a higher degree of certainty than many would have expected.
Yeah, there is that. I mean, it's interesting, given all that's happened in the last week with reversal of some of the trade and tariff policy from the US. The markets have really pulled out some of the rate cuts from the RBA this year. So we were about a week ago or 2 weeks ago looking at maybe 4 cuts this year from the RBA, and that's down to a bit over 3 now. So really taken a cut out.
Yeah, it probably seems a bit more measured and, dare I say, a bit more realistic.
Probably, yeah. We when I wrote in the monthly, I did say I thought 4 was a bit much for this year. 3 probably seems, a more reasonable.
Given the data outlook, as you describe it, the economy has pockets of weakness, but it's certainly not far from being on its knees.
Yeah, well, exactly. I mean, if you think about the RBA's dual mandate of full employment and stable prices, and stable prices means 2.5% trimmed mean inflation, they're almost there. So, there really isn't a great need to cut. Probably can take a few cuts and then just leave it, really.
And then watch this space.
Watch this space.
Now, one of the major news stories over the last couple of days is the last rating agency to downgrade or strip away the US's AAA credit rating on their debt. Probably not a huge surprise.
No, so we had Moody's remove the AAA, or their version of AAA credit rating from the US down to AA1. They're the last rating agency to do that, as you note. So going back to the last sort of, the US debt ceiling crisis in 2011, that was when S&P cut the AAA rating, and Fitch did it in 2023. So they're really the last credit agency to do that. There was a small reaction, 4 or 5 basis points sell-off in treasuries. But I think everyone knows what the story is, that, and Moody's said this, that basically the level of debt and the outlook for debt and deficits is not consistent with AAA. So I think that's no surprise to most people.
Yeah, the level of deficit and the sort of lack of appetite, or I guess clear direction in terms of bringing that deficit under control.
Yeah.
Now, again, they're making that assessment against this sort of updated tariff position, and you introduced a new term into our vernacular last week, the taco trade. Talk us through that one.
Yes, the taco trade, or the Trump always chickens out trade, coined by Robert Armstrong at the Financial Times. So, I mean, the thesis is that every time the market has a violent reaction, Donald Trump reverses that, and we did see that not long after the Liberation Day tariffs. So about a week later, I think on April 9th, he reversed and paused tariffs for 90 days, and then
the bond market was beginning to show a little bit of stress.
Well, bond market and equity market and currency market were all weaker. So that was some evidence of that. And then I think last week we had the someone termed the Geneva Prevention.
Right. Talk us through that one.
The meeting in Geneva between US and Chinese trade negotiators, which saw the 145% tariff on Chinese goods reduced to 30.
To a mere 30.
And the Chinese reciprocal tariffs of 125 down to 10. So a real back down in terms of, both sides. And once again,
especially considering, I think, just how hard the rhetoric was, probably on both sides on that one.
Yeah, and I think it's really interesting because the Chinese said, we'll basically fight to the end and we won't be intimidated. And I think that, reading between the lines, it was the US that really sort of backed down and initiated it. Really worried that there'd be empty shelves within weeks. So there's so many Chinese products that fill US stores, and the anecdotes of the port of Los Angeles and port of Seattle seeing reduced container volumes coming through from China, and so I think that that the US really did back down, and almost completely reversed all the tariffs for 90 days.
Yeah, so many. I was just about to say that so many of these cans keep getting kicked further and further down the road, but such to the point that the markets now are sort of seeming to hugely downgrade their expectations of just how aggressive the final policy framework might be. Well,
as someone said, I think we now have the contours of the upper and lower band. So the lower band, the UK and US
10%.
did a 10% deal, and China now has a 30% deal. So people are now thinking, well, they're the two extremes, so everyone else will probably be somewhere in between. But there is reports that some countries are looking at the way China handled things and thinking, well, why do we really need to cave in to the US? We can play hard as well and, maybe do a better deal. Maybe we don't need to do a deal within 90 days. So there are reports that some countries are dragging their feet a little bit and thinking, well, we can let this play out a little bit longer, and so we've had Scott Bessent, Treasury Secretary, threaten countries and saying if they weren't negotiating in good faith, then they would go back to the Liberation Day tariff rates at the end of 90 days. And so trying to pressure them really to come to the party. So I think the US is now a little bit worried that their bargaining position has been weakened.
The art of the deal is not playing out exactly as they'd hoped. And taking this a step further, we were speaking this morning, and you talked a little bit about how Walmart has found itself sort of in the crosshairs of this one as the tariffs begin to get closer and closer to the consumer. Now the reality bites of who's going to pay the tariff.
Yeah, so last week Walmart reported earnings and really couldn't give a lot of guidance for the upcoming quarter. They did warn that they would probably need to raise prices at the end of May as they run through their inventory. And the tariffs, start to impact them. And over the weekend, Donald Trump, on Truth Social posted, "Oh well, Walmart make billions of dollars, and they should be eating the tariffs." And so I think it was the first time really there was an acknowledgement that US consumers would be paying the tariffs rather than
the exporter.
Foreign exporters. Yeah.
The reality begins to strike.
So, Scott Bessent apparently spoke to the CEO of Walmart over the weekend and said, we will eat some of the tariffs, but certainly not committing to eat all of them. They do try and pride themselves on being the lowest cost, retailer. So I'm sure they will absorb some tariffs, but there's a limit to how much pain their shareholders can absorb, given
just how much margin they have to begin
3% margin. There's not a lot of room there to absorb 100% tariffs.
Firms like Walmart and Costco are famously volume businesses, low margin. And more broadly, the US budget negotiations ongoing.
Yeah, so they've what this is called, this budget reconciliation process. You're trying to get the House Budget Committee to apparently they're meeting Sunday night in the US to try and hammer out a budget. There's a few members of what are called the House Freedom Caucus, who are the more sort of conservative members that are holding out on approving the House version of the budget. They want steeper cuts to Medicaid. They want steeper cuts and faster cuts to climate-related subsidies. And they're worried that the budget with the tax cuts will get worse before some of those spending cuts kick in, because they're meant to be phased in over the next few years. So the tax cuts up front, spending cuts kind of phase in.
Deficit potentially blows out.
Yeah, so four of them are holding out, and they're on the Republican side. So it'll be interesting to see where they go. They're trying to get a deal done. There's this 1,116-page budget proposal. They're trying to get it approved by Memorial Day, which is next Monday. But they've got a tight time frame because in mid-August, the US government will hit its debt ceiling and once again. Yeah. And they're trying to get everything done by July to avoid that.
Excellent. And markets more broadly, we sort of spoke on the last podcast how over the course of April they sort of largely retraced their steps from the more aggressive reaction to the Liberation Day announcement at the start of the month. How do we sit now as we're sort of mid-May?
Yeah, so after another 5% gain for the US market last week, they're up almost 20% off the April 8th lows. So very fast, powerful recovery back to kind of levels seen in late February. Not quite record high, but not far away. So, given everything that's still going on, and that the tariffs will, even if they settle between 10 and 30, that's still a significant increase on where they were and will have an impact on the US economy. So to some extent, markets maybe have bounced a little too hard, given still quite a high degree of uncertainty and potential slowdown coming. So yeah,
a cautionary approach remains appropriate.
But it's interesting, the Mag 7, which we've spoken a lot about on this call over the past few years, their price earnings ratio, the premium that they trade at relative to the other 493 companies in the US stock S&P 500, that premium's back to where it was in 2018. So they've really come back. So yeah, interesting.
A bit of rationalisation and a bit of a cycling there.
Yeah. So they're not as expensive, but still, as we know, still decent growth coming out of them. So I think it's an interesting market. It's a rally that a lot of people are saying is hated because it's come back so hard and is not really pricing in some of the risk. And there is, I guess, a degree of asymmetry to it. Potentially. No, we're not bearish, but we do think that maybe it's come back a bit too hard.
Well, as we talked about earlier in the podcast, there's a lot of things that have been pushed down the road. A lot of 90-day extensions, and we're a long, long way from having certainty on how this all plays out. So
that's right.
A cautious approach sounds prudent. Thank you very much, Nick, as always. Excellent summary, and thank you to all our listeners.